Banks don't think like people, they think like systems, they think like brands, they care about friction, they care about defaults, they care about what happens when something breaks. So if you understand how big brands design behaviour, you already understand how banks make decisions. Why banks care about consistency. Netflix analogy. Banks trust boring people more than interesting ones. Netflix works the same way. If you watch the same type of thing every night,
Tonight's the night.
Netflix relaxes. But if one night it's a drama, then a horror, then a kid's cartoon at 3 AM, Netflix has no idea who you are anymore because you watched absolute chaos. Banks react the same way to money. Regular income, similar spending each month, normal, predictable bills. That tells banks what your next month probably looks like. When money looks random, banks don't think it's bad. No, they think it's unpredictable, which is risky. And when they can't predict you, they protect themselves. That's why boring money gets cheaper deals. Why banks suddenly hesitate. Amazon analogy. Banks panic for the same reason Amazon suddenly double checks your order.
Are you sure?
If you're buying something small on Amazon, like a £5 cable, one-click checkout. Easy. But try ordering something expensive. And suddenly,
Are you sure?
same account, same card. Amazon just slows down. Because once that order goes through, an undo gets, well, complicated. Banks think the same way. Small decisions are easy to reverse. Big commitments aren't. So banks slow things down. Not because they don't trust you, but because it's difficult to undo the decision. That's why big financial decisions feel slow and awkward. Not because something's wrong, but because once it's done, it's done.
Are you sure?
Why banks act like Face ID. Apple analogy. Banks move slow for the same reason your Face ID stops working. You've used your phone for years. Same face, same phone. Then one day, Apple decides it needs to be absolutely sure. Nothing happened. You didn't do anything. Apple just lost confidence. Apple isn't accusing you of anything. No, it's just following a rule. Banks work the same way. When certain boxes get ticked, time passed, details changed, something didn't line up, the system has to stop. Not because it wants to, but because it's not allowed to continue. That's why banks seem slow, but they're not double checking you. They're satisfying the system. And systems don't care about how trustworthy you feel. Why banks care what happens if things go wrong. Deliveroo analogy. Banks see money the same way Deliveroo thinks about refunds. You order food. Everything looks fine, then something goes wrong. Cold food, wrong order, missing fries. If it hasn't arrived yet, easy fix. But if it has, Deliveroo doesn't care how annoyed you are, it cares how hard this is to undo. Banks think the same way. Banks don't just ask, will this go wrong? They ask, if it does, is it easy to reverse? That's why deposits matter. That's why buffers matter. And that's why messy exits scare them. Banks don't lend based on optimism. No, they lend based on how smooth the exit is if it fails. So banks aren't pessimistic. They're planning for failure. Because once money's out the door, getting it back is the hardest part. Why banks care how you earn money? Google analogy. Banks think about money the same way Google Maps chooses your routes. You put in a destination. Google Maps gives you options. Sometimes the fastest route looks a bit dodgy. Back roads, no lighting, I don't know, a flood. Google Maps doesn't say it's illegal to take that route. It just strongly suggests you don't. Because if something goes wrong, that shortcut becomes your problem. Banks think exactly like this. Two people can earn the same amount of money, but get treated very differently. Because one route is stable, and one has more chances to break. Banks don't just ask, how much do you earn? They ask, how does that money actually arrive? Or where is it from? So it's not just the destination they're judging, it's the route. Why banks hate complicated setups. IKEA analogy. Banks look at complicated finances the same way you look at IKEA furniture. You open the box, tiny screws, dowels, mystery bits. Technically, it can be built, but there are a lot of ways this can go wrong. You miss one step and the whole thing wobbles, and you don't notice until the end. The problem isn't the effort, it's how many components depend on each other. Banks see finances the same way. A guy could have one income, one job, a simple setup. It's easy to understand, but someone else could have multiple incomes, guarantors, gifted deposits, side arrangements, It's still valid, just more things that can break. So banks aren't judging how clever your setup is, they're judging how many pieces have to stay perfect for it not to collapse. Simple setups can fail one way, complex setups can fail in 10. Why banks care how close you are to the limit? Pure gym analogy. Banks think about money the same way Pure Gym thinks about treadmills. If you're jogging comfortably at Pure Gym, plenty of room, and not near the edge, no one's stressed. The machine's fine, you're fine. But if you're sprinting, right at the front, one tiny slip away from being launched, you might feel in control, but Pure Gym is quietly nervous. Banks look at money the same way. If your income just covers your spending, no spare room, no buffer. Banks don't think you're reckless. They think one small shock and there's nowhere to recover. That's why being just about fine still looks risky. Not because you're doing something wrong, but because you're running with no margin. Why banks never forget. Spotify analogy. Banks remember your finances the same way Spotify remembers your music taste. Spotify mostly cares about patterns.
W's in the shot.
But if you play one very specific song enough times, Spotify never fully lets go. You could stop listening to it entirely and Spotify will still quietly suggest it. Just in case. Banks do the same thing. They mostly care about how you behave over time, but if you've missed payments before, the system assumes it could happen again. They assume the future you will be the same as past you. So it's not that banks think you'll definitely mess up again, they just can't prove you won't. Why banks hate last minute behaviour. Tesco analogy. Banks panic for the exact same reason Tesco self-checkout panics. If you scan everything normally, slowly, one at a time, the machine just lets you live. But if you suddenly scan 3 things at once, or move too fast, or put something down half a second early, the machine doesn't ask what happened.
Unexpected item in bagging area.
It just decides it doesn't trust you anymore.
How can I help you?
Banks work exactly like this. If your finances suddenly change, new debt, big spending, weird last minute transfers, the bank doesn't know why it happened, and not knowing is the problem. So they don't think this person is bad, they think something changed and we didn't see it coming. When banks lose confidence, they protect themselves. That's why last minute money stuff gets flagged. Not because it's wrong, but because it's unpredictable. Why the same person can be risky and safe. Uber analogy. Banks judge risk the same way Uber prices rides. If you order an Uber on a Tuesday afternoon, cheap, instant, no drama. But order one at 1:47 AM, outside a club, in the rain, same account, same card. Uber just suddenly views you as a threat. Uber doesn't think you became irresponsible. It just knows the situation is messy. Banks think exactly like this. The same person can be safe in one moment and risky in another. Not because you changed, but because the conditions did. That's why banks don't only ask, "Who are you?" They ask, "When is this happening?" and "How bad could it get?" So the same person can get a yes or a very expensive yes. So when a bank makes a decision, it's rarely emotional. It's mechanical. They're not thinking in stories, they're thinking in systems. How easy is this to undo? How many things have to go right? What happens if something breaks? That's how big brands design products, and it's how banks design risk. They're not predicting the future, they're preparing for failure. And once you see that, their behaviour stops feeling random and starts feeling consistent.